Hello investors, I'm Stuart Cruz and welcome to Cruz Asset Management's chart of the day. Today is Unemployment Thursday. It's a day where we get our numbers in for new unemployment initial claims. We are expecting a number of around 850,000 new unemployment claims. And if we go to our friends at White Charts, and up on the chart I have the U.S. initial claims. We hit 870,000, so a little bit worse than anticipated. It's okay. Last week we got a little bit better than anticipated. I'm going to put up on the chart a 4-week moving average, which is the orange line. It smooths out this curve, and basically we're right on our 4-week average. So that might suggest that numbers are getting a little bit better, that we're flattening out. But let's put this into perspective. I'm going to go out to 2008 for right now. And you can see here, this is the financial crisis. This is where we're at. We peaked in the financial crisis March of 2009. So let's actually hone in on that March of 2009. There's our peak of the financial crisis at 660,000. And so we are 35% above that peak of the worst time during the financial crisis. And if we add our continuing claims onto this chart, continuing claims, we're over 100% above the March number, and then the worst line is actually in May. So let's take a look at May. We're just under 100%, so basically twice the continuing claims of what we had in our worst print during the financial crisis. I'm going to switch this chart back to absolute numbers so you can actually see the continuing claims at 12 million claims. And let's look at the unemployment rate next to continuing claims. So here's the unemployment rate at 8.4%. And as you can see, during the worst time of the financial crisis, we were at 10.1. So we're off of that and below that all-time, or not all-time bad print, but worst print in recent history, coming down to 8.4%, but nowhere near, obviously, full employment of 3 or 4%, which is what we got down to right before the financial crisis. And really what we want to be looking at is this U6 number. And so here what I have is the unemployment rate is in the blue line, and this is what the TV pundits will quote. But here's the U6 number, and I think that's a little bit more useful. This U6 tries to incorporate the groups of people that are not employed, but are also not looking for employment. So those able-bodied people that could be working that are just not working. Because you're not really considered to be unemployed if you stop looking. So it seems a little silly if you got just discouraged from looking, and let's say you're okay with just taking a break from the job hunting, then this kind of captures this U6 number. So we peaked out at 22% here. The worst of the financial crisis was 18, so 22%. 1 in 4, 1 in 5 people couldn't or didn't have a job that were able to work. And now we're down to 14%, so that's about 1 in 7 that could work that do not have a job right now. And again, relative to the financial crisis, we are, pretty high up there. So I'm going to show you what the participation rate looks like right now. So here's the U.S. participation rate, and we are steadily coming down, meaning that fewer people were participating in the labor market. We bottomed out in September of 2015 and then started to move up a little bit, and now during the lockdown, our participation rate fell to about 60%, and that's off of the 65% that we saw in 2009, and now we've clawed back up to 61%, but that's well off of even this bad print down here of 62. So for every percentage point, you're talking about millions of people that could be working are not even looking for work. That's why that U6 number is so much higher at almost twice what the unemployment rate is quoted. So these are all really bad indicators. Let's look at some positive news. Here we have the U.S. single-family housing starts. These are houses sold. That's not actually the chart I wanted to show you. U.S. new single-family houses sold And let's get to here. We're at 1 million units sold, and the long-term average, I'm going to just jump this up on the chart. Let's see if we can do this on the fly. Our average line is 678,000 over the last 3 years, and we're at 1 million units sold. So it's about 50% higher. So the housing market is quite strong and has been quite strong off of these April lows. It's continued to rebound, and this high demand with low inventory has caused an increase in the prices. So that's one market area, the market that's been pretty strong. Retail's been strong, manufacturing weak. So there's been a bifurcation of the market, and there's been some tugs and pulls on which area is going to win. And the market got a little overheated, pulled back, and according to some future estimates and multiples, we could still see a little bit more weakness in the market before we actually are kind of at the right value and levels. So we at Cruise Asset Management, we try to make our decisions, or we do make our decisions using math and statistics. So we'll make sure that our clients invest with the odds in their favor.